Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk on sources of long-term finance, part 4 of this topic. So, sources of long-term finance we introduced 2-3 sessions ago. We have talked about many sources so far. We have talked about equity share capital as a source of long-term finance, external of course. We have talked about debentures as a long-term source of finance. We have discussed about project loan or term loan, which is a very important source of long-term finance. And in this session, we are going to talk about preference share capital as a source of long-term finance, preference share or preferred share. So, this was the background, and now I will be talking about the what preference shares are. So, preference share, friends, they are called as preferred stock as well, and are a type of company share that pays dividends to shareholder before any dividend are given to common stockholders, and these shares represent a smaller ownership stake than common stock. So, as the name suggests, preference shares, in many countries it is also called as preferred stock, the stock which has preferences over the equity share or common stock, because even equity share is known as common stock, equity only, or general stock, etc., etc. So, the preference over preferred stock or share, stock is also known as share, is actually having preferences over the common stock or over the equity stock. So, they are the type of the company's shares that pays dividend to shareholders before dividend is paid to the any other type of shareholder, right. So, it means they have a priority on the dividend, and these shares also represent a smaller ownership than the most of the companies would issue preferred stock only of a small amount, or many companies would not have any issue of preference shares. It is also very common not to have preference share in the total financial structure, right. So, but nevertheless, if they are issued by a company, they have preferences for the dividend, they have preferences also for the principal money invested by them at the time of liquidation. They have preferential claim on assets at the time of liquidation, and they could be participatory, they could be non-participatory. We will talk about those types very soon. But overall, a major reason that why do we call them as preferred share is because of the preference given to these type of shareholders over the equity shares. That is why they are called preference shares. Now, preference share could be of couple of types, 3-4 types. So, they could be cumulative, non-cumulative, they could be participative or non-participating, they could be convertible or non-convertible, and they could be redeemable or non-redeemable. So, let me explain these 4 types of preference shares to you: cumulative or non-cumulative. So, preference shares are issued, like for example, 11% preference share, 12% preference share. This is what is written on the face of the instrument, which means the financial instrument as a preference share. So, if company do not have let us say profits in a particular year, the cumulative preference share would have that 11% or 12%, whatever the rate of dividend is written, accumulated for the next year to be paid in next year, or when the profits are maximum, generally up to 3 years. So, that real practical accumulation is allowed because of the type, right. Non-cumulative, where the preference shares do not have the option of accumulating of the dividend. So, cumulative will have the non-paid dividend accumulated to be paid next in the future. Non-cumulative will not have that option. Participating shares are those preference shares where the shareholders have right to participate in the profits after a particular rate of dividend is paid to them, and also a profit is paid to equity share. So, any remainder thereafter, a certain amount of amount is paid to equity share, a limited whatever is specified. Thereafter, if there are profits exceeding that, they may have the right to participate in that, right. Non-participating shares do not have right to participate in any extra profits after paying them whatever have they been paid and after paying to equity shareholders. Convertible and non-convertible is an option. Convertible means preference shares can be converted into equity shares after a certain period, maybe after 5 years, 10 years, 15 years, whatever the duration it is written in the terms and condition at the time of issue of such shares, right. So, if that option is given, the preference share would be known as convertible. Non-convertible means, of course, it is quite evident, means the option to convert into equity share or to get the ownership is not there to the shareholders whom have been issued non-convertible preference shares. Then the last is redeemable or non-redeemable. So, now as per the mandate in India, non-redeemable are not issued, all preference shares have a redeemability, means they are redeemed after certain period. So, and that time is also specified, but this type is still discussed in books, and I just am I am mentioning it as well, that non-redeemable is not an option anymore in the country. So, what are the merits and demerits of preference shares? So, merits of preference shares are there is a fixed dividend, relatively less costly, no delusion of control, no charge on assets, liability to pay dividend can be postponed. So, let me explain these points to you now. The first and the foremost advantage of preference share is the liability to pay dividend is well known to the company in advance and is also fixed, right. So, company knows that they have to pay 11% or 12%, etc. Unlike in equity share, company has to pay everything whatever is left after paying debenture holders or any other type of project loan or any other loan, interest on those loans, and to the preferential capital holders, the whatever is left remainder is actually that belongs to equity shareholders. So, they are taking risks, but they have the high return possibilities as well. So, company may have to pay higher dividend because that was expected in the market, or to retain the share price at a higher rate, company may have to pay higher dividend. But in case of preference shareholder, it is very well known to company that how much is the dividend. So, a company can plan accordingly, all expansions, modifications, or any other thing can be planned well in advance, keeping into consideration this payment amount. And it is also relatively less costly than equity share. Preference shares are hybrid form of financing. We call them as hybrid financing. Why? Because there is a certain level of features which belongs to, which are like debentures, and certain features are like equity share. So, for example, company has fixed liability when it comes to dividend. So, it is very much like debentures where the interest is also fixed, right. But if the preference share is participating, then it becomes somehow like equity, or if convertibility is there, then it becomes equity shares after a few years, very much like equity only. So, it is relatively less costly than equity, but it has a slightly higher cost than debenture. So, if we have to put three sources, debenture, preference, and the equity in order of when it comes to their cost, finance cost, Debenture is the cheapest one, followed by preference share capital, and last would be equity. Term loan would be higher than debentures and higher than, generally higher than in preference even. So, this is relatively less costly than to equity, and the no delusion of control, because preference shareholders do not have voting right unless an exception cases they get the voting right. If cumulative preference shareholders are not paid dividend for 3 years, and in the fourth year they get right to participate in voting, right. Otherwise they do not have voting right. And preference shares holder, because equity share have the ownership, preference share do not have ownership right. So, there is no question of delusion if the voting right is not there, because ownership is there to equity share, and they exercise control through votes. Preference shares do not vote, they cannot unless the exception I just mentioned. So, that is how the possibility to delusion of control is none, minimum, or in case of participative, or in case of cumulative, it is very less. No charge on assets, so they do not have charge on assets, unlike term loan where loans are secured and there is they have a charge on assets, right. So, that is how the preference shares is not that easy to issue preference shares, and there is, it is not that every company would be able to sell it. So, there is no charge on assets, means companies will not have assets given as secured term loans or secured debentures even for times. So, here there is no charge. So, this is advantage to the company. Liability to pay dividend can be postponed maximum up to 3 years as per the law I referred, but this the laws keep on changing. So, liability can be postponed up to a certain extent. After that they become they have the participation right to vote, right. So, they actually become real sense, they become the participative share. So, what are the demerits of the preference shares? So, relatively expensive source due to non-tax benefit of the company. It is not an option for charitable or section 8 companies and must be redeemed in 20 years except for infra projects. So, let me explain these 3 points to you now. So, the foremost disadvantage of preference share is that it is relatively expensive. Why? Because if we compare it with the even the term loan for that matter, or the debentures, because even term loan we are paying interest, on debentures we are paying interest, and interest being the finance cost is a tax deductible item, right. So, any company for that matter would prefer to negotiate for a loan over than issuing a preference share. That is why I said preference share, though by name has a preferred stock, is taken as a preferred stock, but is not a preferred option of financing any project or anything in a company because of the cost, because of the limitations of issuing, etc., etc., right. So, this is a very important limitation from the company's perspective, that it is an expensive source of finance to the company, because no benefit of tax is there on preference shares, issuing of preference share to the company. Then there is a limitation that a company which is formed under section 8 of Companies Act or the charitable company, they are actually, they do not have option of issuing preference share at all. So, a section 8 company cannot issue preference shares. Other companies may not prefer to issue preference share, right. It's a very interesting that but nevertheless preference shares cannot be an option, or companies under section 8 cannot issue preference share. This is a limitation. And the another big limitation is that these preference shares, as I said, now non-redeemable, are not issued. So they must be redeemed, in 20 years time for all the projects other than, infra projects. The projects like infrastructure development, like dams, hydro plants, or roads, etc., etc. If preference shares are issued for that purpose, for that reason only, the project can be preference share can be redeemed, within 30 years or late. Even there is a capping for that as well. But for rest of the purposes, it means for a normal corporate, normal business other than the real estate infra projects, rest of the companies would need to redeem them within 20 years. So, it's longevity of the preference share capital, availability of preference share capital is only up to 20 years for most of the businesses. So, these are the limitations from company's perspective, and the limitations from the shareholders, preference shareholder perspectives are what? It is a hybrid source. So, they do not get, though they have a certainty of the income, but they do not get paid well when it comes to equity shareholders. So, returns are limited. They also do not get the voting right by like debenture holders, because equity shareholders have ownership right, they exercise control in management, but preference shareholders do not. So, that becomes a limitation. It all depends upon, on the investors. Why is an investor interested to invest? If somebody is looking for exercising control, high rate of dividend returns, then the investor will go for equity share or other options of investment. But if you are looking for a safer source, then as an investor you may consider debentures as a source to invest in a corporate, or preference share to invest in a corporate. So, I am not reviewing other options of investment, mind you please. I am just reviewing the long term sources of finance which we are discussing. I am making comparison and critical discussion on that part only, right. So, as an investor, you do not have a voting option, you do not have option to expect higher returns unless it is a participatory. So, these are the limitations from shareholders perspective as well. So, friends, these were the sources, primary sources of long term finance. There are few more instruments which I want to discuss in future series, but just to conclude that today we have talked about two major sources, preference shares as a source of long term finance, and the term loan other than the debentures, their merits and demerits. So, to conclude, I would say that the preference share is a very important source of finance which few companies exercise because of the limitation of issues, because of the limitation in terms of years. The years, only 20 years, the availability of such funding through preference share is available only for 20 years, right. And except for infrastructure projects, and also that this ends up as an expensive source to the companies because of no benefit of tax. So, preference shares are though known as preferred stock, but they actually are not a preferred source of financing over the equity, because equity shares holders have a very great option of exercising control in management. They are the true owners. When company is liquidating, they get right to own assets. They get right to own everything after paying to preference shareholders as well as to the debenture holders. So, in true sense, the ownership is in the hand of equity shareholders, not in the preference shareholders. And not only that, debenture holders have a legal right to go and put up a case in the court of law for liquidation of a company for non-payment of interest and non-payment of principal money. preference shareholders do not have such a straight right in comparison to debenture holders. So that is a pity, because it is in between. It is neither equity, it doesn't have the features of equity, doesn't have the features of full or complete features of debentures. So it is in between, it is hybrid. So it has certain features of both of them, and it is a less preferred stock. So friends, I would want you to actually visit certain websites of companies, look at their capital structure, find out the sources of financing they are using, and then you will get a fair idea that what is the preferred source of financing for a company. And I will not be surprised if you observe that a particular sector in a particular industry has preference of a certain source of finance, because the financial institutions which are extending finance, let us say the term loan. So there are certain industries which are having a longer gestation period. There are other set of industries which are having lesser gestation period, right. So because of that, there is a mushrooming of financial institution to fund X type of industry, and there is a mushrooming of another set of financial institution to fund another sector, right. So if you go and observe and you do it as a project, you will really have a great observation and great learning, in fact a true sense good learning, that this particular set of financial institution is funding infra projects. This particular set of financial institutions are funding FMCG sector. This particular set of financial institutions are funding startups, right. So that would be really a great learning to observe and learn that why particular source of finance, long term finance is so common or more familiar or more prevalent in a particular set of companies or particular set of sector. And you may observe that this difference is also from geographical area as well, which means a particular area of the country would have a great source of funding. The companies operating from that area, they have a great major resources received from a particular type of long term source, maybe debentures, maybe term loans. So in some area you will find term loan is very common, is higher, highly populated, popular. In other area, equity share is the most commonly used source, right. So and equity shares also have the limitation. Every company cannot go for IPO, equity cannot issue IPOs, and there are certain restrictions on that. So so these are the major features, characteristics of the sources of finance we discussed, and I hope you are able to compare them. You would have gathered their characteristics, their merits, their limitations, and I would like to now wind up, friends, with this these are the long term sources we discussed today, and time to sign off. Thank you very much.